American homeowners have collectively lost $374 billion in equity over the last 12 months, according to Cotality. That's the largest single-year equity erosion since the 2008 financial crisis. And the pattern unfolding right now mirrors 2007 in one critical way. The damage didn't start everywhere at once. It started in specific overheated markets, and then it spread. Back then, Las Vegas, Phoenix, and the Florida coast were ground zero for almost a year before contagion went national. Today, Florida has dominated the headlines. Cape Coral, Punta Gorda, Lakeland, those names became shorthand for housing crash. But the institutional data from Cotality, Intercontinental Exchange Mortgage Technology, Atom Data Solutions, and the Federal Reserve Bank of St. Louis is telling a different story now. Florida's correction is actually decelerating. Inventory in Cape Coral and Sarasota is falling year over year. Meanwhile, 12 other American cities have quietly leapfrogged Florida in distress. Here are the markets crashing harder than Florida in 2026 and why homeowners in these cities need to pay close attention. 1. Austin, Texas, the new epicenter. No market in America has fallen further than Austin. Home prices in the Austin metro are down 27.8% from their 2022 peak, according to Resi Club Analytics using Zillow's Home Value Index. That's a deeper collapse in Cape Coral, deeper than Punta Gorda, deeper than any Florida market that spent 2 years dominating national crash coverage. ICE Mortgage Technology, which tracks more than 60% of all active U.S. mortgages, reports that 9.2% of Austin home loans are now underwater, the highest negative equity share of any major American metro. If you bought an Austin home in 2022, there's roughly a 1 in 4 chance you owe more than the house is worth today. Median days on market just hit 91, the slowest pace since 2011. Nearly half of active listings carry at least one price reduction. Travis County inventory is at its highest level in over a decade. And Redfin's migration data now classifies Austin as a net outflow metro for the first time in modern history. The California wave that built the city has reversed. Resi Club's Lance Lambert called Austin the epicenter of resale housing market weakness in 2026. 2 and 3, San Antonio and Dallas-Fort Worth, Texas. Austin isn't a Texas anomaly. It's the leading edge of a statewide unwind. San Antonio is down 11.2% from its 2022 peak, with 8.8% of mortgages underwater, the third highest negative equity share in the country, ahead of Jacksonville, Florida. Median days on market jumped from 72 to 98 in a single year, and 35% of San Antonio buyers are now searching outside the metro entirely. In Dallas-Fort Worth, the high-end northern suburbs tell the clearest story. Frisco, Plano, and Prosper are down 6.1% year over year, with inventory 62% above the long-term average. Smart Asset ranked Plano 5th worst in America for year-over-year price drops. Builders in Texas exurbs are offering 2.99% mortgage rate buydowns and free upgrades because they can't move standing inventory. Atom Data Solutions confirms Texas led the nation in foreclosure starts in Q1 2026 with 10,617 filings, more than any other state. For Houston, Texas. Houston's headline numbers look deceptively stable, positive migration, roughly flat median prices. Underneath the surface, it's a different story. Houston's foreclosure rate jumped 88% year over year, the largest annual increase of any major U.S. metro. It's now the second highest city in America for foreclosure starts. Flood and insurance pressure in Montgomery and Fort Bend counties is doing to Houston's exurbs what climate pricing did to coastal Florida, just more quietly. 5. Denver, Colorado. The Denver metro is down 10.6% from its 2022 peak, with the city of Denver itself down 12%. Active listings are 139% above July 2023 levels and 48% above the pre-pandemic baseline. This isn't normalization, it's structural oversupply. Colorado bank repossessions tripled in a single year, jumping from 99 completed foreclosures in Q1 2025 to 321 in Q1 2026, the largest percentage gain among major states in America. Denver's luxury condo segment now sits at 26 months of supply. There are units in Cherry Creek in downtown Denver that won't sell until 2028 at current absorption rates. Redfin ranks Denver as the 8th largest net outflow metro in the country. 6. Phoenix, Arizona, the West Valley. The Phoenix metro is down 11.6% from peak, but the suburbs carry the heaviest damage. Buckeye, the West Valley exurb that exploded during the pandemic, is down 11.6% year over year. Goodyear, Surprise, Queen Creek, Santon Valley, and Maricopa are all now flagged as buyer's markets by the Cromford Index. Builder distress is loudest here. Toll Brothers CEO Douglas Yearly disclosed that per house buyer incentives climbed from $68,000 to $80,000 in a single year. Pulte Group CEO Ryan Marshall said directly that Texas and West market demand remains slower relative to the rest of the country. The builders know. 7, 8, and 9, the Carolinas. Most people think of the Carolinas as a Sunbelt success story. The institutional data says otherwise. Columbia, South Carolina posted the third worst foreclosure rate in the country in Q1 2026, one filing for every 440 housing units. For all of 2025, it ranked second nationally. South Carolina as a state saw foreclosure filings rise 39.7% year over year. Myrtle Beach is worse. The condo market is down 12.2% year over year, with average days on market at 143. Single-family active listings are up 36.6%, the fastest growing inventory in the Carolinas. And according to Houseo's March 2026 report, 79% of Myrtle Beach listings now carry at least one price reduction. That's more than double Cape Coral's rate. Charleston registered the third worst foreclosure rate among cities with populations over 500,000. The city median is down 5.1% year over year. Days on market have hit 89, and First Street climate risk data confirms 71% of Charleston properties face severe flood exposure over a 30-year horizon, a figure now showing up in mortgage applications and insurance underwriting. 10 Cleveland, Ohio. Cleveland's year-end 2025 foreclosure rate was one filing for every 187 housing units, technically worse than Cape Coral, Florida, at 1 in 189. Ohio fell from 14th to 43rd on Neil Hall's annual growth index, the steepest single-year migration drop in the country. The Cleveland Case-Shiller Index is still technically positive on prices, but a foreclosure pipeline is signaling what the price chart hasn't admitted yet. 11, New Orleans, Louisiana. New Orleans is down 19.1% from its 2022 peak. Louisiana has the lowest equity-rich rate in America at 20.1%, and 9 of the 15 worst counties for negative equity nationally are in Louisiana. The primary driver is insurance. Insurify projects the average Louisiana homeowner premium will hit $13,937 this year. In February, 18% of pending New Orleans sales were canceled because buyers couldn't secure affordable insurance, up from 10% the year before. 12, Atlanta, Georgia. The city of Atlanta is down 8% from its 2022 peak, with some surrounding suburbs down nearly 11%. Nearly 40% of Atlanta sellers are cutting listing prices. Georgia foreclosure filings rose to 77.8% year over year, the steepest jump of any state. And Atlanta just flipped from a net domestic migration gain of over 16,000 to a net outflow of roughly negative 2,000. The largest single-year migration reversal of any major American metro. The bigger picture, a delayed detonation. The foreclosure moratoriums and forbearance programs of 2020 and 2021 didn't prevent a housing crash. They postponed it. ICE mortgage technology data shows active foreclosure inventory has now hit 273,000 loans, the highest level since February 2020. FHA loans now make up 55% of all seriously delinquent mortgages, a record share. The wave that federal relief was supposed to absorb is now hitting in 2026, exactly when the Federal Reserve and the home building lobby are calling this a normalization. The people running the actual businesses aren't pretending otherwise. Lennar Executive Chairman Stuart Miller acknowledged his company is currently carrying 14% in buyer incentives against a normalized level of 6%. D.R. Horton disclosed that 73% of its closings now involve a mortgage rate buy-down. KB Home CEO Rob McGibney said plainly that some of his customers are potentially upside down when they try to sell. And on December 10th, 2025, Federal Reserve Chair Jerome Powell stated, "Housing is going to be a problem. We can raise and lower interest rates, but we don't really have the tools to address this." When Powell, the largest home builders in America, and the institutional mortgage data are all saying the same thing, this isn't a soft landing. It's a slow motion crash that began in Florida, moved through Texas, climbed into Mountain West, reached the Carolinas, and is now surfacing in places the national media hasn't named yet. If you own a home in one of these 12 markets, the question isn't whether your equity is at risk. The question is how much of it has already evaporated while the headlines were looking somewhere else.